Look at the world around you. Look at the buildings, the factories, the ships crossing the oceans, the gold sitting in vaults. If you were to add up the price tag of every tangible asset on Earth, every home, every ounce of stock, every barrel of oil, the entire GDP of the global economy, you would reach a number somewhere around $100 trillion. That is the real economy. It is the sum total of human labor and resource extraction. But hovering above that real economy, invisible to the naked eye, is a second economy. It is a ghost in the machine. It is a dark, churning ocean of bets, contracts, and promises that creates no product and provides no service. It is a mathematical abstraction that has grown so large, it now dwarfs the real world by a factor of 10. The value of this shadow market is estimated at $1 quadrillion. That is a 1 followed by 15 zeros. It is a number so large it defies human comprehension. It is more money than has ever existed in the history of our species. But here is the terrifying paradox. The money isn't there. If the investors in this market were to demand their payouts all at once, there isn't enough currency on the entire planet to settle the bill. We have built a financial doomsday machine, ticking quietly in the background of your daily life. They call this the derivatives market. But to understand it, you shouldn't think of it as a market. You should think of it as a casino where the gamblers have bet more money than the casino actually owns. And unlike a casino, when the house loses here, the lights don't just go out in the building. They go out everywhere. To understand how we arrived at the precipice of a $1 quadrillion cliff, we have to strip away the jargon. The financial elite use complex language to gatekeep simple, often dangerous truths. They talk of liquidity, hedging, and counterparty risk. But the concept at the heart of the shadow market is ancient, and it stems from a very human desire: the desire to control the future. At its core, a derivative is simply a contract between two parties that derives its value from something else. It is not the thing itself. It is a bet on the thing. If you buy a stock, you own a piece of a company. If you buy a derivative, you own a bet on which way that stock will move. It seems like a subtle distinction, but it changed everything. It allowed the financial world to detach from physical reality. For centuries, wealth was anchored to the ground. If you wanted to be rich, you needed land, cattle, or ships. There was a physical limit to how much you could own, because there was a physical limit to how much existed. But once you start trading in bets rather than things, the limits vanish. You can create an infinite number of bets on a finite number of assets. You can sell the same risk to 1,000 different people. This is the great secret of the modern financial system. We are not living in an economy of production. We are living in an economy of speculation, where the shadow cast by the object has become heavier and more valuable than the object itself. And like all shadows, it grows longest just before the sun sets. The story of this shadow world doesn't begin on Wall Street. It begins in the humid, bustling port of Osaka, Japan, in the late 17th century. The Dojima rice exchange was a chaotic, noisy place filled with the smell of unwashed laborers and the dust of 1,000 sacks of rice. Samurai, who were paid in rice, needed to convert their harvest into cash. Merchants needed to buy rice to sell in the cities, but rice is heavy. It rots. It is difficult to transport, and its price fluctuates wildly with the weather. A bad harvest could ruin a merchant. A bumper crop could crash the price and starve a samurai. So, the merchants of Osaka invented something brilliant and dangerous: the rice ticket. These tickets were promises. A warehouse would issue a piece of paper claiming that the bearer was owed a specific amount of rice at a specific date in the future. Suddenly, the merchants realized they didn't need to haul heavy sacks of grain back and forth. They could just trade the tickets. The ticket became money. Then, a subtle shift occurred. A shift that would eventually lead to the $1 quadrillion bubble we face today. Merchants began trading tickets for rice that hadn't been harvested yet. They were buying and selling the future. And then they took the final fatal step. They began selling tickets for rice that they didn't have and had no intention of ever touching. They were speculating on the price of rice, using the ticket as a pure instrument of gambling. The shogunate saw the danger. They saw that the value of the tickets on the exchange was often greater than all the rice in Japan. They tried to ban it, calling it empty trading. But the allure of creating value out of thin air was too strong. The modern futures market was born. The genie was out of the bottle. Fast forward to Chicago in the 1970s. The principles of the Dojima rice exchange had evolved. Farmers used futures contracts to protect themselves. If you were a corn farmer, you could sign a contract in April to sell your corn in October at a fixed price. If the price crashed, you were safe. This was the noble origin of derivatives, risk management. It was insurance. But in the high-rise offices of Chicago and New York, a new breed of banker was watching. They were mathematicians, physicists, and game theorists. They didn't care about corn or wheat or pork bellies. They looked at these contracts and saw a playground of pure numbers. They lobbied governments to deregulate the market. They argued that if you let people bet on anything, interest rates, currency fluctuations, the default of a government, you would spread the risk around. They claimed that by slicing and dicing risk into millions of tiny contracts, they could make the market efficient. They promised a world where financial crashes were mathematically impossible because the risk was diluted. They were wrong. They didn't dilute the risk. They hid it. And by hiding it, they allowed it to grow in the dark, unmonitored and unchecked. They built a tower of complexity that no regulator could understand and no government could control. Let's look at the mechanism of the trick. How do you turn a few $1 trillion of real money into a quadrillion dollars of exposure? You use leverage. Imagine you want to buy a house that costs $100,000. In the real world, you need to put down a deposit and get a mortgage. But in the derivatives market, you don't buy the house. You simply enter a contract that says, if the house goes up in value, I get the profit. If it goes down, I owe the difference. Because you aren't buying the house, you don't need $100,000. You might only need $1,000 to open the contract. With that $1,000, you control an asset worth $100,000. This is leverage. It amplifies your gains, but it also amplifies your losses. Now multiply this by the entire global banking system. Banks began writing contracts on everything. They wrote contracts on whether interest rates would rise by a fraction of a percent. They wrote contracts on whether Greece would pay its debts. Then, they did something even more surreal. They created derivatives of derivatives. They bundled thousands of these bets together and sold them as safe investments. Then, other banks bet on the value of those bundles. It became a hall of mirrors. Consider the credit default swap, the weapon that almost destroyed the world in 2008. It sounds technical, but it's essentially an insurance policy against a fire. However, in the real world, you can only insure your own house. In the shadow market, your neighbor can insure your house. The mailman can insure your house. A hedge fund in London can insure your house. Suddenly, you have a situation where a $100,000 house burns down, but because there are 5,000 insurance bets placed on it, the total payout owed is $500 million. The actual asset, the house, is meaningless compared to the mountain of bets stacked on top of it. This is the definition of the shadow market. The side bets have become larger than the game itself. We saw the first tremor of this in 2008. The narrative you were told is that people bought houses they couldn't afford, and the banks lost money. That is a lie, or at least a convenient half-truth. If it had just been about bad mortgages, the damage would have been contained. The global economy can absorb a few $100 billion of bad loans. The reason the world almost ended was the derivatives. When the mortgages failed, they triggered a chain reaction in the shadow market. The insurance payouts came due. Giant institutions like AIG suddenly owed hundreds of billions of dollars in payouts on these side bets, money they did not have. The banks stopped trusting each other. No one knew who was holding the toxic bag. They knew that on paper, their rivals were solvent, but in the shadow market, they were dead. The credit gears of the world ground to a halt. Ships stopped moving. Payrolls weren't met. We were hours away from the ATMs shutting off. Governments stepped in. They printed trillions of dollars to plug the hole. They told us they had fixed the system. They passed laws like Dodd-Frank. They demanded transparency. But did they actually dismantle the machine? No. They simply put a fresh coat of paint on it. Today, the shadow market is larger than it was in 2008. The players have changed, but the game remains the same. The danger has migrated from mortgages to even more abstract frontiers. One of the most terrifying modern parallels is the volatility market. Investors now bet on how fearful the market will be. They are not betting on the price of a stock. They are betting on the mood of the traders. Algorithms execute these trades in microseconds, reacting to news headlines and keywords before a human eye can even read them. We also see this in the rise of flash crashes. There are moments when billions of dollars of value evaporate in seconds, only to reappear moments later, because the algorithms in the shadow market entered a feedback loop. These are the tremors of a system that has become too complex to control. The shadow market has also moved into the currency of nations. Countries use derivatives to hide their true debt levels. They swap currency obligations to make their balance sheets look cleaner than they are. It creates an illusion of stability, a facade of health. But beneath the surface, the leverage is building. This system relies on one thing: continuity. It relies on the assumption that tomorrow will look mostly like today. The mathematical models that run this quadrillion-dollar engine assume that markets follow a normal distribution, a bell curve. They assume that extreme events, wars, pandemics, total collapses, are statistical anomalies that happen once in 1,000 years. But history teaches us that once in 1,000 years, events happen every few decades. When they do, the correlations go to 1. All the bets fail at the same time. And when you have $1 quadrillion of notional value dependent on a stable reality, a crack in that reality can shatter the entire glass castle. Why does this matter to you? You might think, I don't own derivatives. I don't trade futures. This is a game for the rich. It matters because your money is in their vault. Your pension fund is invested in their schemes. The cost of your groceries, the gas in your car, and the interest rate on your credit card are all manipulated by the gravity of this massive shadow planet. When the shadow market sneezes, the real economy catches a cold. When the shadow market crashes, the real economy starves. This system has turned money into a weapon of mass destruction. It has incentivized short-term profit over long-term stability. It rewards the gambler and punishes the saver. It is a mechanism that transfers wealth from the productive many to the speculative few. But there is a silver lining, a realization that comes when you stare into the abyss of these numbers. Understanding the shadow market breaks the spell of financial authority when you realize that the masters of the universe are merely playing a high-stakes video game with leverage. You stop looking to them for safety. You realize that true wealth isn't a number on a screen. True wealth is what survives when the screen goes black. It is land. It is skills. It is community. It is the ability to create, to build, and to sustain. The shadow market is a claim on wealth, but it is not wealth itself. It is a map, not the territory, and maps can burn. The quadrillion-dollar bubble is a testament to human hubris, the belief that we can conquer the future with math, but the future remains undefeated. The system is fragile because it is built on faith, faith that the debts will be paid, faith that the counterparties are good for it, faith that the music will never stop. We cannot predict when the next correction will come. We cannot say which domino will be the first to fall. It could be a bank in Europe, a real estate developer in Asia, or a glitch in an algorithm in New York. But we know the dominoes are set. The best defense is awareness. Do not be dazzled by the complexity. Do not be intimidated by the jargon. Look at the system for what it is: a house of cards built on a foundation of sand, reaching for the heavens. It is a reminder that in the battle between the real and the imaginary, reality always wins in the end. The ledger always balances, one way or another. History doesn't repeat, it reveals. And if you understand the past, you'll see the future more clearly.